You got the same excuse now times 10, okay? But if gold barely went to 8,000, that's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. If we went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think it easily go into that zone.
Gold's recent rally to near all-time highs has ignited fresh momentum in the precious metals market, with market analyst Michael Oliver reinforcing his bullish stance. In a recent interview, Oliver emphasized that this surge is only the beginning of a much larger upward trend. His momentum structural analysis, which has guided his bullish outlook on gold since 2016, suggests that both gold and silver are on the verge of an explosive move, particularly as financial markets weaken. According to Oliver, the long-term trajectory remains intact, and the forces driving this rally, ranging from inflation concerns to shifting investor sentiment, are likely to accelerate in the coming months. Oliver firmly believes that the stock market's current position is unsustainable and ripe for a significant correction. He points out that while the S&P 500 and NASDAQ have remained relatively flat since their July peaks, underlying weakness is beginning to surface. In his view, even a moderate 5 to 10% drop in equities could act as a catalyst, pushing investors towards safe haven assets like gold and silver. This anticipated shift, he argues, is likely to fuel further gains in the metals market, creating a self-reinforcing cycle of rising demand. Oliver highlights that gold has already demonstrated resilience in times of economic uncertainty, and as market conditions deteriorate, the influx of capital into gold could drive prices significantly higher. Beyond gold, Oliver is particularly enthusiastic about silver, which he believes remains severely undervalued relative to its historical trends. He points out that silver's industrial demand has skyrocketed, particularly in the renewable energy sector. The solar industry, in particular, has become a major consumer of silver due to its essential role in photovoltaic cells, and this growing demand is vastly outpacing the annual production of the metal. Oliver stresses that this supply-demand imbalance could create a significant squeeze, driving silver prices much higher in the coming years. He also challenges the notion that silver has lost its monetary significance, asserting that its price movements have historically aligned more closely with gold than with other commodities. Before watching the video, subscribe and hit the bell icon to stay updated with our latest uploads. We'd love to hear your thoughts, so comment below.
If gold went to 8,000, it's no big deal. Why that number? It's not a projected target or anything of the sort. All I've done is go back to when gold was legalized, 1975. You've had a couple of bull markets that were eightfolds. From the mid-1976 low to the 1980 high was $1,003 up to $850. Okay, 3.5 years. Then over a span of a decade, you went from early 2000s up to 2011. It went from $260 to $1,920. Okay, another eightfold move. Now we have fundamental and technical dynamics that are in play that are far bigger than those periods of time. So the excuse that gold had to do that, you got the same excuse now times 10. Okay, but if gold barely went to 8,000, that's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. If we went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think it easily go into that zone. The issue is the ratio of silver to gold and the ratio of the gold miners to gold. And we think that is breaking out to the upside, favoring them because the last several years they've underperformed gold. Actually, since the 2015 low, you mentioned the gold miners a while ago. You measure from the 2015 low to the present, gold miners are actually beating gold, even though they're not above their 2020 price high, and gold is above its 2020 price high by a significant amount. But from the bare low, for instance, in the XAU index, in December 2015, low monthly close to its current price. You go back and look at it on your charts, do the math. How much up is XAU? It's actually up more than gold is, measured from its low monthly close at 1,060 back in December 2015 to the present. Yes, they've lagged over the last several years where gold has launched and they've stayed below the 2020 high in the miners. They're about to blow through that. And I think the ratio, the spread relation between the miners and gold is about to go vertical, where they outperform gold in this phase, and silver does the same. And I personally, and we state this in our reports, what positions we have. My emphasis is in silver and the gold and silver miners and in silver miners.
The likelihood of a U.S. recession appears to be rising, but experts caution that a severe economic downturn is not inevitable. Despite this, uncertainty has already unsettled financial markets and shaken both consumer and business confidence. Statements from former President Donald Trump and his cabinet members suggesting that economic turbulence could be an acceptable price for sweeping policy changes, such as tariffs, mass deportations, and federal budget cuts, have added to concerns. While policymakers argue that these measures will strengthen the economy in the long run, the short-term impact could lead to disruptions in employment, government services, and overall economic stability. Historical data shows that recessions often leave lasting scars on individuals and communities, with consequences ranging from job losses and lower incomes to increased debt defaults and rising mental health issues. As John Harvey, an economics professor at Texas Christian University, points out, economic downturns can contribute to social problems such as substance abuse and psychological distress. Treasury Secretary Scott Bessent has acknowledged the uncertainty, stating that he can't guarantee the U.S. will avoid a recession. The International Monetary Fund notes that while each recession is unique, they share common characteristics: declining economic output, rising unemployment, falling housing and equity values, and financial market instability. While some believe the economy may be resilient enough to withstand these pressures, others warn that prolonged uncertainty and policy shifts could make a downturn more severe.
We're getting down there in the area. We think the first support level for the S&P and the NASDAQ 100 will be at an idiot price level. And I call it idiot because it's back. You go back to the 2021 high in NASDAQ and the 2022 high in the S&P and draw a line across. Do that on your screen. And when we get down there, there's certain momentum reasons that we think that could be a bounce level. Now that's, we're talking 4,700, 4,800 S&P, so that's not crash dimensions. A crash is 30 to 35% in a couple of weeks. I don't think you're going to have that this time. I think you're going to have a layered double-digit type painful decline, but not a crash event. And as we've already seen, those who are persistently holding to the false narrative that if the stock market does good, it goes a downside big time, gold and silver go downside. Baloney. History does not prove that. There are a few rare examples where you can find an instance, but they're instances. They're not the major trends. And I think the downside in the stock market, and we've seen it for the last several weeks, is quite serious. And yet gold has gone up and silver has gone up sharply. And the gold miners have gone up even more on a percent basis over the last 3 weeks. So it's a falsehood. And that will help fuel gold and silver and the miners. And frankly, there are not many other alternatives out there that you can find that look like they're moving opposite to the stock market. But I don't think it will persist much beyond a quarter or so. We see at every bull market peak in the last couple decades, they cut rates, all the way down and the market yet implodes. So I think that's where we are, except we're at a more historic point. And I think that's coming. And I think that the political forces at work right now will have helped exacerbate that, not cause it. I know that the one side of the equation here is going to say, see, when he became president, the market went down. It was going to go down anyway. Our technical analysis said we didn't care who won. She could have won, it wouldn't have mattered. You're still topping out, you're going down, and that bubble's going dark. And she would have been blamed for it, or now he gets blamed for it. So it's going to be an interesting year. And we argue that the best place to be, especially over the next year, maybe even beyond, is going to be in the monetary metals, particularly what people perceive as the underperforming aspect of that arena, the silver and the gold and silver miners. We think they'll vastly outpace gold in terms of percent gain.
Gold's supply side is facing significant challenges, with global production expected to decline. Aging mines are shutting down, and ore grades, the concentration of gold within an ore, are falling, making extraction more expensive. Some mining companies are also closing due to rising labor and regulatory costs. Analysts predict that these factors could cause global gold production to drop by 17% by 2030. As a result, gold prices are projected to surge, with 2025 forecasts ranging between $2,300 and $3,500 per ounce. UBS expects gold to peak at $3,200, while Bank of America sees a potential high of $3,500. If recession fears intensify, central banks and institutional investors may accelerate their gold purchases, further boosting prices. Given these dynamics, gold remains a critical hedge against economic uncertainty, offering both stability and long-term value in a volatile financial landscape. Share your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates.